Welcome to the Private Equity Experience Podcast, your backstage pass to the strategies, stories, and secrets that drive value in the PE universe. No filters, no fluff, just straight talk and expert insights to help you navigate the private equity world with confidence. And now your hosts, Ed Barton, Rory Liebhardt, and Emily Sander.
All right. We're on the Private Equity Experience Podcast.
It's good to be back.
2 quick questions to get us warmed up here. So we'll settle this once and for all. Please stack rank the following kinds of roll-ups. Fruit roll-ups, sushi roll, rock and roll, payroll. Ed, go.
Payroll always is at the top of the list.
Yeah.
And then I'll do rock and roll. Then I'll do sushi roll. Then I'll do a fruit roll-up, because fruit roll-ups are just like leather fruit crap. I mean, it's like...
The
Yeah.
leather sugar,
Yeah.
to dissolve in your mouth.
Yeah,
But if
I'm
you're
aligned
on a
with that.
marathon, you
Yeah.
might need that.
Yeah, I was just going to say, if you're into endurance things, then having a fruit roll at hand is not a bad way to go. You know, it's pretty calorie dense, but I'm with Ed, payroll tops, both as on the receiving end as CFO. You always want to be making payroll. That means you're doing all right. Rock and roll, I'm into that as well. Sushi rolls, yeah. I love a good tempura roll. So those tend to hold weight in my world too. So yeah. Tough to stack rank with it. Those are all good.
Yeah, there we go.
Yeah.
Basically, I'm picturing Ed and Rory doing payroll while listening to rock and roll.
Yeah.
They're eating sushi rolls and they'll have a fruit roll up for maybe like a dessert once in a while.
Exactly.
All right. Second quick fire question. If you had to own 17 of the same kinds of businesses, which ones are you picking and why? A, coffee shops. B, dog groomers. C, car washes. D, nail salons. E, mini golf courses.
Oh, car washes. That's easy. Those are far more passive than the others. I could get
Oh.
coin-op car washes and kind of go fill up the soap and collect my coins.
Yeah.
And that's it, man. The rest of them, I got to get people to actually do the work.
I like that. I also, amongst the others, I would probably put dog groomers up there. So it's both a luxury and a necessity for people. So you can do all sorts of crazy creative things to grow that kind of business. You can offer financing, and they're typically probably a good credit risk. People are going to look to pay their bills related to their pets before other things, and after a mortgage and a car probably. So that would be a good one. Probably hard to build a back office for it, but could be done for sure.
I like how seriously you're taking that question, thought out from a financial perspective.
Yeah.
Awesome.
Yeah. Gotcha.
Rory, take us away. What is a private equity roll-up strategy?
Well, I like a lot of these things. I would say in the private equity world, the terminology is a lot of times pretty self-explanatory, which I'm grateful for. But what it is really, it's a strategy to use investment capital to buy up, kind of businesses in the same industry, but in a kind of what would be like kind of a fragmented sector, perhaps. Put them together, make them better, eke out costs, take on debt, sell it later at a higher multiple. In a nutshell, that's what it is. There's a lot more to it, of course. That's what it is at the fundamental level.
That's a good summary, Ed.
Podcast over. No, I'm kidding.
No, and it's far more common than you think. We've talked a fair bit, during the podcast and in the book around the strategic acquisition. So, you want to get acquired by a strategic. Well, a lot of times the strategic that's acquiring you is private equity backed, and it's actually part of a roll-up strategy. And I can kind of point to a number of the companies I've worked with on the private equity side or owned personally, where part of the strategy is to look for a roll-up. And I'll give an example in professional services, which is where I sit today. You can look at, let's say, an accounting firm. Accounting firms will trade small ones, 2, 3, 4 partners, solo practitioners. They trade at 2x to 3x EBITDA. A well-organized mid-size accounting firm will trade at 7 to 10x EBITDA. And so there's a strategy, as Rory noted, where you go, okay, I'm going to find these small firms that they've got a good book of business, they've got an interesting niche, they've got something, but I'm buying it at 3x. I
Yeah.
bring it into my ecosystem. I make it more efficient. I put new systems in place. I put new processes in place. And now I get an arbitrage, essentially free money of like it doubles in value just by bringing it into that ecosystem. And if I can do that 4 or 5 times, I could grow a very large firm and make a ton of money doing it. Now, the execution is the hard part, but the concept is very straightforward.
Yeah.
Okay.
Yeah.
So I'm hearing like some of the same things though, because you go in, you have to make the business more efficient. Maybe the internal processes are not set up like they should be, or you need some different things here and there. So that part seems similar to what we've talked about in the past. But then you're putting it in this strategy in this ecosystem where you're leveraging, you're arbitraging the nature of it almost. Is that
Yeah. I mean, there is so much to it, and it can be a highly effective strategy and one that is, pretty much the private equity playbook, but it is also one where it could be a really great spreadsheet exercise, but making it happen and come together along the lines of how you're trying to go ahead and build value and sell, it's way more easier said than done. Think about what we're talking about here. And I'm not saying every single roll up instance is fragmented sort of independent businesses, but most of the time that's where you're going to get the most value if you can execute it. But think about any independent business you know of, likely has its own culture, likely has its own ERP system, its own way of going to market, yada, yada, yada. It has its own independent strategy. And then to try to bring in other businesses sort of in that same, cohort and then make them all come together, cohesively, that's really difficult to do. And, us being in leadership, it's so much of a people thing. It's so much of a systems thing. Making that happen is oftentimes the hardest part, right? If the market's there and you can get bigger multiples by combining businesses, great. But there's a lot of spade work that has to happen to get yourself to that point where you're ready to sell and realize that value.
And just for folks listening, are we talking about the exact same types of business, like accounting firm, or is this, I'm trying to think of one off the top of my head, accounting firm and like something adjacent to an accounting firm that they would typically need?
A lot of times if you're rolling up something that's very similar. So
Yeah.
roll up essentially implies that you're taking a bunch of smaller things and you're rolling them into a bigger thing. The vertical integration, that you're kind of talking about, which is, well, maybe I've got and going back to our prior employer, where we acquired a smaller web services provider, and then we acquired a different web services provider in a different niche, but it was basically the same business. It just was in a different vertical. That's a classic roll up strategy. We acquired two different businesses, rolled those up, built some efficiency into it. Kind of redeployed the best people to the right places and executed in at various levels of good. But the process is normally not, well, I've got a accounting firm and now I'm going to go roll up a law firm and then I'm going to go roll up a HR consulting firm. You can do that,
Right.
but that takes all the risks that Rory just talked about with people, processes, tools, and technology, and amplifies those risks because you now have, it's not the same business. The key is basically the McDonald's method of, you acquire these businesses and then you work to put them into a framework that is proven, that's efficient, that's scalable to be able to realize the value out of those businesses.
You put them into a framework, but it's not a franchise.
Right. Yep.
Nope.
Okay.
It's a good way to think about that. Exactly. So yeah, it's it's one of those areas where if you're going to have a roll up strategy, you really, really need to understand the customer from each of the independent business standpoints. And this could easily turn from a private equity podcast to just a business leadership podcast, in so far as if you alienate your customer by making your sort of roll up, merged business portfolio more generic and you lose some of the nuance with your customers, especially for independent businesses, you could basically be cannibalizing the overall picture for yourself. So, at the very end of you need to be able to do the things that make these strategies create value, which is get cost synergies, get supply chain leverage by being bigger, get access to cheaper debt by being bigger, et cetera, et cetera. But even if you do those things and yet you alienate your market you're in somehow by making things less personalized or independent, whatever, I mean, it's a risk that you take to destroy the value of your company in this, while you're financially engineering your way to more value, if that makes sense. So you can't lose sight of the fundamental aspect of, treating your customers well, understanding your product market fit, delivering basically.
And in some of those cases, the risks are, dramatically different. So for example, I executed on a roll-up strategy in the glass contracting business. So glazing contracting, much less risk because folks tend to hire you for a project. You don't have these long-term relationships. Your folks tend to be, you either have a unionized workforce or you have, a technical workforce that is in and out, but they're, I don't want to say they're homogenous, but you're able to replace them easier from a skill set perspective, not necessarily find them easier, especially in the trades, but from a skill set perspective, a glazer tends to be. You go into accounting, for instance, where I sit today, and you have long-term relationships. It's a very personal relationship with your CPA. So all of a sudden they decide to leave, or you execute this strategy and some of the employees decide, I'm out of here, and they take the clients with them. That becomes a very tough strategy to execute. So roll-ups, that execution piece, like Rory said, the alienation of the customer base, the risk level is dramatically different depending on type of what business you're in and what your interactions are with those clients.
Yeah.
So if I'm a PE firm, do I decide like we're just doing roll-ups across everything? We're like a roll-up PE firm, or is it we're going to deploy this strategy for some or in some conditions, or for how do I decide as a PE firm how to utilize the roll-up strategy?
The interesting thing from my seat is every PE-backed business that I've worked in has all said, we've got capital available and we're going to go look for strategy for strategic acquisitions to roll up into this business. In most cases, they've actually done that. And in most cases, that has also been, at least in a couple cases, that's also been when I was brought in because it was not going well. So it was, the roll-up strategy is sexy on paper. It's extraordinarily difficult to execute in practice. And you need folks who both get the vision of, okay, here's what we're trying to accomplish, and are willing to, and again, this is my bias, but willing to go, okay, maybe the better mousetrap sits with the acquired company. So, we're going to kind of take the best of everything, and you become a true operator. How do I operate for greatest efficiency? But it is kind of in the playbook of pretty much every private equity backed business I've been in. It's just whether that play is executed well, or in some cases they're like, well, we said that, but we don't have capital left in the fund, so we're not going to execute on that anymore.
Right. Or in other cases, I've been part of a group. I've been part of a group that was a financial services roll-up strategy. So maybe not is exactly homogenous as saying, like a accounting firm, but basically complementary, tech-enabled services, yada, yada, yada. So by virtue of the capital markets being robust, the M&A market being robust, one of the strategies that is employed sometimes is go ahead and buy up a bunch of companies, start the integration process, but basically hand off the half integrated company to another PE firm to take it the rest of the way. And so a lot of times that's done unintentionally, where, you execute a roll-up strategy and you're just like, this is way harder than I expected. But maybe in that time that you held that business, the capital markets improved in your favor and the M&A market got better. So you could actually sell for a higher multiple, even though you didn't realize the value creation from the actual rolling up itself. So then you trade it off and you sell that as a success to your LPs, and you're off and you're doing it again. But that's just to say that some of these things get half baked, and maybe even sometimes just par baked even, and then traded, and it could actually turn out to be a successful deal, just by virtue of some luck and some timing and, some vision, but maybe not as much execution.
So without the luck and timing, though, can you walk me through the arbitrage piece? Like, let's say, I mean, like, what's an example? Like an HVAC company or a landscaping company or a whatever veterinarian company. Pick your flavor here. But how do I get that arbitrage advantage?
You actually hit on one that is in the sexy category right now, which is veterinarians.
Yeah.
On roll-ups, veterinarians, dentists, optometrists, so a lot of the medical professionals.
Yes, exactly.
And so here's how the roll-up strategy works. Here's how the arbitrage works. You've got, let's call it a veterinarian. They've got, it's a doctor with a couple vet assistants, and they're serving. And I'll use a composite of a few of my clients because I've got a few that are in that business.
Yep.
Then they've got, they're maybe doing a couple $1 million of business, and they do farms out in Arlington, Washington. And VCA, which is Vet Corporation of America, comes up to them and goes, and the doc might be in her late 50s, kind of looking at what the transition looks like, and you've got a couple choices. You could sell the practice or not, or you could close it down, or try and bring someone in and transition over time. And VCA comes in and goes, look, here's what we can do. We're going to give you cash. We're going to retain you for 10 years. We're going to give you options, or we're going to give you stock in the business. And what's going to happen is you're going to be on the VCA system. So we're going to do your marketing for you. So now you don't have the marketing cost. We're going to do your accounting for you. We're going to do your payroll. We're going to do your taxes. So now you eliminate a lot of, like Rory led off with the back office piece, the back office
services.
All that goes away.
Yeah,
so now you save yourself 10, 15 points on your bottom line just on the back office. And then they go, okay, well, this business, if you look at the risk premium you would pay for a business associated with a sole practitioner doctor in a small town, that risk premium is going to be pretty high. So you might only pay 3x EBITDA for that business.
Yep.
But now you've all of a sudden got VCA as your owner, and they've got 450 vets that they've got in their ecosystem, including folks fresh out of college all the way through getting ready to retire. And so, Doc decides that she wants to retire a little bit early. They've got 450 vets that they can go, we're going to transition you. They're an employee. We're going to transfer you to Arlington. You're going to take over this practice. So now that risk premium goes down, and you might go from a 3x EBITDA to a 6x or 7x EBITDA.
Okay.
And so you've not only cut cost because you don't have redundant back office and those things, you've also reduced the risk in the business because you've got, especially in professional services like vets or optometrists or what have you, that risk of it's all revolving around that single doctor or those two doctors now is mitigated by the fact that they've got a pool of professionals that they're going to be able to draw on, attract, recruit. And so it drives the value up. And then when they go to sell that business, they go, now it's not a $2 million practice. It's really a component of a $250 million medical practice that they're selling, for $2 or $3 billion as opposed to, 1x revenue or 3x EBITDA.
Yeah.
Okay.
Yeah.
So there's some different players in there, though.
Yeah.
There's
And, another one that enters the fray, as is the case pretty much with, I would almost venture to say almost every private equity deal is lenders. So you might be asking a question, gosh, you go roll up a bunch of businesses. That's just got to be a lot of capital you got to put out the door. And yes, to a degree, a lot of it not your own, if you have a lender that you're working with. And so you can just think about people. In our book, we like to analogize real estate. This can also be the same, right? Like you go buy one veterinary practice and that has cash flow to it. You can use the assets and the cash flow of the business to secure more debt financing to go buy another one. And you buy that one and it has cash flow characteristics and it's got some assets and it's got some predictability. Banks like that. You can go buy another one and another one. You keep stacking and stacking and stacking until you get to have a big enough portfolio and you can demonstrate that it's working cohesively and you can continue to get better financing. And then you're increasing your potential ROI to your original LP investors for that original bit of equity they put in, and you're using debt smartly. Now, that also poses some of the biggest risk in this whole thing. Let's say you have 4 portfolio companies rolled up, one of them goes sideways, but you saddled the whole thing with a bunch of debt. Well, that could pose a lot of covenant issue or just general non-performance issues as it relates to keeping up with the terms of your loan. So you might end up finding yourselves with tight to covenants or low on cash flow. So you end up having to restructure things. And in a worst case scenario, by using all that leverage, you could tank the whole deal for your LPs. But that's what these financial engineers are paid to do. They're very smart. They generally use debt wisely, but it is a big risk for sure.
The other part that Rory just hit on the leverage side is your financial engineers, your private equity folks. Most of them do not have on the ground practical experience in actual execution of a roll up. They've done it by spreadsheet. They've done it, as a manager, as a portfolio, as a company in a portfolio
spreadsheet and pitched via PowerPoint. Yes.
Yeah. But they have not had to be in the trenches. And so
Exactly.
in some cases, and I have run into this where, and I won't name names, but everybody knows probably who I'm talking about. There was a roll up where basically the chief operating officer and I said, do not do this. This makes no sense. There are no efficiencies. I see vapor in their technology. It doesn't make, we're going to move forward because this just makes a world of sense for us. It did not. And it distracted. It was a nightmare for a year and a half until we essentially sold the business again. So the execution part is hard. And if you do that with leverage, you've added a significant amount of risk into the deal. And if you don't execute, and a lot of times, as we've talked about on the pod, the leverage that's added is coupled with covenants, and those covenants kind of factor in the expected efficiencies associated with the acquisition and the cost savings and the increased cash flow and all those things. And if that doesn't get realized, you're going to blow yourself up real fast. And that execution piece, if you're on the operator side of a roll-up strategy, so you're kind of an operating management team, if that is a stated strategy of your PE sponsor and they are actively looking for roll-up candidates, it is imperative that you be part of that process and that you understand what's being asked of you going into it from a thesis perspective, because it may or may not pay out. They may take a very good business and blow it up because they've gotten too aggressive on a roll up and don't understand the actual blocking and tackling of that integration and efficiency gain.
Yeah. And that raises another really important point. And you've actually been in this situation, Ed, where you're one of the sort of, call it, executives parachuted in to try to execute one of these things. You did it in the restaurant space specifically. And I'm going to use another kind of derivative of that, is to say, a lot of times you just need to figure on bringing in executives and professionals that know what it takes to do an integration, to do a roll-up, not even necessarily an industry pro. Ed, you weren't necessarily a restaurant retail guy, but you were an executive manager that knew how to put businesses together and get people to walk in the same direction together. So that's what it takes. You have to budget that in. And these folks, they're high value, so they ain't cheap. Like bringing in a team like that is a massive investment in its own right. So this doesn't happen magically. It takes real grit in the trenches work to bring it all together. And maybe a little luck too, sometimes.
And you said if the PE sponsor has a stated strategy of a roll up, but do they always announce that? Is that transparent? Are they flying by the seat of their pants and figuring out as they go? Or is that always, nope, we're doing a roll up strategy. Everyone knows about that.
It's generally not flying by the seat of your pants. I would say that. I think there's some decision making that can be somewhat flip at times, but I'd say on something like this, you're generally not flying by the seat of your pants. But sometimes it is a matter of an evolving understanding of the business. So like maybe a PE gets into a business and realizes that the industry is way more fragmented than they originally anticipated. And some of that comes from, they buy a company and they get to know the founder more, that they learn the business that much more figure out the trials and tribulations of being in that space. Then they're like, well, screw it. I got a ton of capital to deploy. Let's go roll this whole thing up. If your business has this much to unlock, it's been run inefficiently until we just bought it. Imagine these other businesses are in the same boat. We can extract more value that way. So let's just go big. That happens for sure. Absolutely.
But with each one of those like turns, which each one of those additions, it looks like a straight line on a spreadsheet, but then you have the market conditions and the industry and the leadership teams and the synergies and the niches that you might blow up by getting too big. So all of these,
You mentioned regulatory,
level,
you have other things. If you start to roll up too much, perhaps you bring in antitrust type of perspectives, things like that. You don't often think about that, because you only think about that with like, the largest companies in the world, but it is a consideration, regulatory factors that may not be apparent out the gate, but as you get into it, could emerge for sure.
Yeah, what I would say, is with maybe one exception, every private equity backed business that I've been associated with has been acquired by another business executing a roll-up strategy.
Yeah.
So they've been ultimately acquired by a strategic buyer, oftentimes backed by private equity, although the one Rory wrote all the way through was a public company, but it was basically a roll-up strategy.
Yeah,
the roll-up strategy is kind of
at the end of the day, honestly. Yeah.
It was the roll-up strategy is the cat's meow from the standpoint of, we've talked about get a strategic buyer. That's likely where you're going to be able to get the highest value. It's because of all the things we just talked about, the elimination of redundancies, the ability to get efficiencies. And that's a roll-up strategy. It's going to get executed on you as opposed to executed by you.
That's a good one. That actually made me think about it just from a slightly different perspective, which is really kind of how it can go, is if you're part of a business that is being looked at by a private equity group that is looking to execute a roll-up strategy, you may have some leverage there, to extract a higher price for your company. If you know that their intention is to roll it up and then, gain more through size and scale, then you can use that to your own negotiating advantage and say, look, this is a critical piece to your strategy. This is why this company is worth X amount more now than what you're offering me. So it can work both ways. You can, if you're a buyer, you need it to work by paying the right price, as always, very obvious. As a seller, that is a moving target. The right price is the highest price you can get for your business. And if you have a very motivated buyer that has a grander strategy and maybe another party that just wants to buy your business for cash flow and basically, do a DCF analysis, discounted cash flow analysis on your business to get to a purchase price, maybe you want to go with the group that's looking at a big multiple on selling a rolled up merged entity. So I don't know. That's just a perspective you could think.
You just said something. If you're a founder, can you start a mini roll-up strategy yourself to become more attractive to PE groups?
Totally. Absolutely. Yeah.
Oh, you
Absolutely.
can roll
Matter
yourself
of fact,
up.
if you can demonstrate, and the concept, and we've heard it, is this is the platform company. So you essentially go, we've got this.
That's a key buzzword. Yes.
The platform company, so that we've got scalable systems. We're designed to be able to integrate new businesses. We've got folks on the management team that have done this before. We can be a good platform company for a roll-up strategy in. And the one that was classic when I was younger was the funeral home industry all rolled up, because those all used to be little individual ones. And you had a couple platform companies that were like, look, we know how to do this. And they partner with private equity, and then they go out and make offers on all these other companies. That is a way for you, even as a relatively small business, as a founder, if you can position yourself as an ideal platform company, you're going to get a much higher valuation out the gate than you would if the PE guys have to figure out how to use you as a platform company and kind of make that transition first. It's going to have a faster execution.
Exactly.
So the characteristics of an ideal platform company, is it kind of like the hub of a wheel, and you can blob on, you can integrate other companies. It's like, we know how to do that very well.
Yeah.
We know
operational excellence. It's an operational excellence play. We know how to to sell well. We know how to report well. We know how to do finance well. We do all those things well. And our systems are set up in such a way that if you doubled us in size,
You can scale.
we can scale that quickly and without linear cost.
Yeah. You know what don't make good roll-up companies? Banks. You know, there's been so many bank acquisitions, obviously, and you don't necessarily think about it as a roll-up, but it really is. There's so many community banks have rolled up, but so many of these systems are so unique to these entities that integrating them and the architecture behind it it's a massive CapEx spend. So you see a lot of times, they'll roll up and they'll be in the same company, but they're still not integrated. Like one that comes to mind, just more recently is like with the SVB and First Republic and those guys blowing up kind of last, I guess it's 2 years ago now, First Republic got absorbed in Chase. I have both of these banks as like business banks for my entities that I work with, and still they're basically treated as largely separate from the systematic standpoint. So it just is what it is. But, the biggest value you can get is through cutting costs and getting better deals for yourself from, your vendor suppliers by virtue of your scale and, kind of getting leverage from people and all of that stuff. And then on icing on the cake's the capital markets advantage. And, sounds easy, but, there's so much to it.
And just to pinpoint this for people, we've talked about a lot of things that are really close to roll-up strategy, but not quite, like vertical integration, like franchises. And I was thinking through, well, I've been at companies where they want to acquire their competition, so they glob up market share, right? And that's the strategy, but that's not quite being a platform company. So this is a very kind of specific thing we're talking about, not to be confused with other adjacent.
All those things kind of qualify as roll up. It's just kind of when
the rationale is still synergy and efficiency on all those things. Ultimately.
Yeah, one's a California roll, one's a tempura roll, but they're all rolls, and it's the same theory. They just taste a little bit different.
Yeah.
Okay.
Yeah, and I mean other things to consider too. I mean, you might have companies in the same industry very similar, but what if you have some in the in Europe and some here? I mean, those are two totally different animals in a lot of ways. So I'd say like almost as seamlessly, it's like to be in the same market, in the same geography, the same laws and the same standards and things like that, to make it more effective. But that doesn't mean that it can't be also effective to acquire competition globally and then, gain synergies from it. We're just saying like, a very vanilla roll-up strategy involves pretty much like type things in the same place that just could benefit from some scale.
Are there PE companies who specialize in this, where they know all the creepy crawly things that can crawl out of a rock if you turn it over, or they know like it's not as easy as a spreadsheet, guys? It sounds sexy, it sounds nice, but it's a lot of work. We're good at that work. We specialize in that. Or the PE firms just go like, yeah, it's part of our strategy. It sounds great, and we're great at that.
That's a good question. My sense, and keep me honest here, it's easier to say that there's companies that just don't do those things. And what I mean by that is PE groups and PE funds that basically just buy assets rather than as much as operating companies and things like that. So you exclude that group. I think you'd be hard pressed to find a PE group that says, yeah, we're not very good at integrations and sort of leading through value creation. Like, I don't think that that's really a thing, but I think there are certainly some that maybe are better than others by virtue of like just basically getting with the right management team. And it's one thing that we actually didn't spend time too much talking about in our book. A little bit we did. We haven't really on our podcast, but PE groups and PE funds, so much of their success comes from who they have in their corner as operating partners, which is a little bit different. So different than a limited partner, but what you see is a lot of, call it semi-retired, very, very successful people that have done a lot of exits and stuff, being part of PE funds as a second career. Maybe they've spent their first, part of their career as CEOs, COOs, chief of staff, really successful people in their own right as operators. But then you take that operating knowledge and experience to a fund that's an investment strategy. That's a powerful combination. So I'd say the PE funds that have the best operating partners to to sort of complement their investment prowess are possibly going to be more successful than others that are just like, hey, we're just really smart investors, because it takes people being in their sleeves rolled up to make stuff happen.
That might be a future pod for us
It
too.
should, yeah. That kicked off
Yeah.
a little nugget.
We live that with Lone Star funds. They have an entire advisory
Absolutely.
that has, what I always called was like the shadow cabinet, which you had CIOs, COOs, CTOs, all those kind of sitting up at the fund level in
Well, you were that guy for a while for that.
Yeah,
you kind of flopped in and out of like
multiple portfolio companies,
operating company, PE got
yeah, and it was exactly for that reason, is they wanted to have they wanted to have a team that had been there, done that, to help folks be there, do that, or to be there and do that for them if they couldn't.
Yeah.
And bigger firms, bigger PE firms, I think that's table stakes for them. But we saw even with the last PE firm we were with, Emily, that they were moving that direction.
Yeah.
And I think that's going to be that is more and more common, and I think folks are recognizing what Rory just said, which is there's a lot of value to be unlocked with just a few key operating partners that can help bridge the difference between the spreadsheet and the execution.
I've seen that more and more with chiefs of staff too. So yeah, that's a cool topic.
Absolutely.
As we wrap up the roll-up strategy, anything else to add, or just what would you leave people with as a recap? I'm kind of picking up, you can take small companies and make them into large empires if you want, but it's not an ATM machine. It's not free money.
It's
There's lots
not
of risk involved.
I think the two things to take away are it's far more difficult to execute in practice than it is to model. And then the second piece is, I believe, and Rory kind of alluded to this, every private equity firm that has operating companies has this tool in their toolbox and are prepared to deploy it if they have capital to deploy. It's really a question of how well they deploy it and whether that's a core competency or not of that PE firm. But if you're in a private equity backed environment, that tool, and you're an operator, that tool is likely in your PE financial sponsors toolbox, and they're likely to at least talk about it and explore it, if not use it.
Yep. Yeah, I'd be hard pressed to elaborate any more on that. There's always going to be an age-old discussion on whether value creation comes best from organic growth or inorganic growth through M&A and so forth. And the cliche answer that you might expect is probably somewhere in between, right? Like you need to be very fundamentally sound in managing a business regardless of the circumstances. But if you are, then applying that playbook to other similar like type businesses can accelerate the time frame to realizing value. And if you're very savvy and you understand the capital markets really well, and you're, as we keep saying, a little bit of luck involved, it can take a 2 or 3x multiple, 2 or 6, 7 plus multiple if you do it right. So it's tantalizing for sure.
There we go. We'll call it a wrap there. Thanks, Rory. Thanks, Ed.
Thank you. Talk to you all soon.
If you enjoyed today's episode, please like, share, and subscribe wherever you get your podcasts.